Hello, and welcome to the next in our series of information videos intended to help treasurers and members of the Kirk session to feel more able to understand accounts and the associated jargon used by accountants. My name is Jenny Simpson, and I'm the Head of Finance and General Treasurer at the Church of Scotland. In this session, I'm going to look at the general concept of accruals accounting. And whilst all of what I talk about will be relevant to charities preparing their accounts under this basis, I'm not focusing on charities today. There's a further video introducing accruals accounting under the charity SORP. So today we'll have a look at a general balance sheet and I'll explain what each of the things you'll see on a balance sheet means. Then, finally, we'll have a look at the income and expenditure account or profit and loss account. I've tried to summarise on this slide the key principles of accruals accounting, and it's really all about matching. Under accruals accounting, we record transactions when they occur, rather than just when they hit the bank account. Using the matching principle, we recognise income and the costs of earning that income in the same accounting period. We track and record income that we've earned but not yet received, and costs that we have incurred but not yet paid. The difference between this way of accounting and receipts and payments accounting, which we looked at in a previous video, is that in receipts and payments accounting, you record income and expenditure that has gone through the bank account in the year, and you note any amounts you owe or are owed in the statement of balances. Under this way of accounting, you actually record amounts you owe or are owed in the accounts as costs or income respectively. Let's move on and have a look at a balance sheet. And I've broken this down to fit it on my slides. This is the top part, showing fixed assets and current assets. And in the next few slides, we'll talk about what we mean by each of the terms you can see here. It's important to note that a balance sheet is prepared at a point in time. In the case of our congregations, that would be the 31st of December. So we're taking a snapshot of the position at 31st of December, and the balance sheet shows our assets and liabilities at that point in time. Starting with tangible fixed assets. These are assets you use over an extended period of time. They would include things like buildings, cars and vans, and larger pieces of equipment, including IT. The principle behind this is that if you buy an asset to use over an extended period of time, it's not a fair reflection to charge the cost of the asset in full in the year you buy it. Instead, we capitalise the asset onto the balance sheet and then we depreciate it over its useful life. In accounting terms, depreciation is a way of allocating the cost of an asset over its useful life. It's an example of the matching concept. You're matching the cost of the asset to the period you derive benefit from using it. As an example, you buy a minibus for £100,000 and expect it to last 4 years. You would capitalise the £100,000 when you buy the bus, and then you depreciate it by £25,000 in each of the 4 years you use it. What that means is that each year, you reduce the amount you're holding on the balance sheet by £25,000 and you charge that amount as a cost in your income and expenditure account. But that's a very simple example. What if the minibus was going to be worth £20,000 at the end of the 4 years? We'd have it in the balance sheet at nil value, but then we would receive £20,000 when we sold it. So we estimate the asset's residual value and then write the difference between the original cost and the residual value off over the useful life. In this case, our depreciation reduces to £20,000 per annum to write the bus down from £100,000 to £20,000 over the 4 years. It can get even more complex than that. Some people choose not to write assets down in equal amounts, called the straight line basis. They use a reducing balance method to recognise that assets depreciate more quickly at the start of their lives than towards the end, something that would be particularly accurate for a car. It's also possible to record tangible fixed assets at valuation, but that's very complex and outside the scope of what I'm covering today. The next item on our balance sheet is fixed asset investments, and these are investments which could be in stocks and shares, or in the case of the Church of Scotland Investors Trust, in units, but they're held for the long term. You're not intending to sell a significant part of them in the short term. Accruals accounting requires that we adjust the amount we show in respect of investments to market value at the date of the balance sheet. So we obtain a valuation of the investments and we adjust the amount we'd previously shown up or down according to how the value has changed. That adjustment goes to our income and expenditure account as an unrealised gain if the value's gone up, or an unrealised loss if it's gone down. Moving down our balance sheet, the next thing we get to is current assets. Where our fixed assets were things we were using or holding over an extended period, these are assets that are more short-term in nature, and there are various types of current assets. Firstly, we have stock. Recording stock on our balance sheet is key to applying the matching principle. If a business buys in 100 widgets and expects to sell 60 of them this year and 40 next year, then it's not fair to reflect the cost of all 100 in this year. Instead, we record the cost of the 40 we have in stock at the balance sheet date on the balance sheet as an asset, and we only recognise the cost of the 60 widgets that we've actually sold as a cost against the income we've received for them. Moving on to debtors, these are amounts that are owed to you. So if you've sold something prior to the year end, but the customer hasn't paid you yet, then we make an adjustment to bring in the income from the sale and a corresponding debtor onto the balance sheet. When the cash is received after the year end, we record the cash in the bank account and match it against the debtor, thereby removing the debtor. Next, we have accrued income, which is where you're entitled to income, but you haven't even raised an invoice or submitted a claim for it yet. An example would be gift aid on donations. You're entitled to claim the gift aid, but it's highly likely that you won't actually have prepared and submitted the claim until after the year end. Under the accruals accounting concept, we accrue the income so that we record it in the period it relates to. And finally, we have prepayments. These occur where you pay an expense that relates either partly or wholly to a future period. An example might be insurance. If you pay your annual insurance premium of £24,000 on the 1st of November, then 2 months, November and December, relate to your year, but 10 months, being January to October, relate to next year. Recognising the whole cost in the year you paid it is not correct. So to match the cost to the period it relates to, we take out 10/12 and prepay it as an asset on the balance sheet. Moving a bit further down our balance sheet, we come to the section where we show current liabilities. I'll explain what these are shortly, but please note here that after our total current liabilities, we have a subtotal called net current assets or liabilities. This is an important figure on the balance sheet and we'll talk about it a bit later. We previously said that current assets were assets of a short-term nature, and the same applies here. Current liabilities are amounts you owe at the balance sheet date that you're going to have to pay in the short term, within 12 months of the balance sheet date. So you'd include any invoices you've received before the year end but not yet paid, or if you have employees, you would include the PAYE bill for December as a liability. Within current liabilities, we also record accruals, which are basically the opposite of prepayments, and are used to record liabilities where the whole or part of the cost has been incurred in your year, but you haven't had a bill yet. As an example, if your electricity bill for the quarter ended 31st of January comes in February, and it's for £900, then 2 months of that bill, November and December, relate to your year, and so you would accrue 2/3 or £600 at the 31st of December. We also record deferred income in current liabilities, and this is where you've actually received income, but it relates to a service you'll provide after the year end. Deferred income is quite complicated for charities, so we'll cover it in more detail in a future session. Now we come back to our subtotal for net current assets or liabilities, and this is simply your total current assets minus your total current liabilities. If your current assets exceed your current liabilities, you have net current assets. And if your liabilities exceed your assets, you have net current liabilities. Your current assets are your short-term or liquid assets, cash and things you hope will turn into cash quite quickly, like debtors and stock. Your current liabilities are the amounts you have to pay in the short term. So if your short-term liabilities exceed your short-term or more liquid assets, then it can be an indicator that you're struggling to pay the bills as they fall due. A balance sheet showing net current liabilities is not a definitive indicator of problems, but it does mean you'd want to dig a bit deeper and ask questions to understand if there was an issue. It's what we refer to as a technical insolvency. Moving on to the bottom part of our balance sheet, you'll see we now bring in our long-term liabilities, which are amounts that are due for payment in more than 1 year after the balance sheet date. So there are some creditors, such as a loan, that you'll need to split to show the amount payable within 1 year in current liabilities and the amount payable in more than 1 year in long-term liabilities. We then total up our assets and liabilities to give us either net assets or net liabilities. Again, net liabilities is a technical insolvency, and you definitely want to understand the financial position in more detail if your balance sheet is showing net liabilities. Finally, at the very bottom of our balance sheet, we show our total funds, split between restricted funds and unrestricted funds if you're a charity. This is where the balance part of a balance sheet comes in. Your net assets should equal your total funds, and if it doesn't, then your balance sheet is wrong somewhere because it doesn't balance. Finally, today we'll have a quick look at the income and expenditure account, which is also known as a profit and loss account or an income statement. And the income and expenditure account records all of your income and all of your expenditure for the period. It reconciles your opening balance sheet to your closing balance sheet. The figures shown for income and expenditure are on the accruals basis. So income will include amounts you haven't received yet. We've brought the income in and recorded a debtor on the balance sheet. Similarly, expenditure will include things you haven't paid yet because we've recognised the cost and included a creditor or an accrual on the balance sheet. I hope you found this introduction to the accruals accounting concept useful, but as always, if you have any questions, please don't hesitate to contact either Presbytery or the Stewardship and Finance team in 121.